Okay, welcome to this week's episode of Jason Talks Tax. Alright, so every single week we get a client that asks us, should we be an S-Corp, an LLC, a C-Corp? And I always tell them the answer is it depends. What kind of business are you? What's your goals, right? Because let's start from the beginning. What's great about LLCs is that the flexibility, right? LLCs can be treated like a sole proprietorship or it can be treated like a corporation, right? And if the LLC is just an LLC without corporation treatment, what I always tell people is that there is no tax advantage to that. An LLC is just there for legal protection. Hence, that's why people put rental properties into an LLC, is because they get legal protection, right? That's why we always advise clients, best case scenario, put one asset in each LLC, right? One LLC, one asset. The only challenge there is the more LLCs that you have, the more expensive it becomes, especially if you are in a state like California where there's Secretary of State filings, there's the $800 minimum payment that you have to make every year. Plus, depending if you have partners or not, you might have tax preparation fees for each one of those LLCs. So I totally understand why people put multiple properties into an LLC just for an economic purpose. But just keep in mind that for the maximum legal protection, you want to have one asset for one LLC. But if you can't do it, maybe something you could look into is umbrella insurance, okay? But once again, I'm not a lawyer, so talk to your lawyer first before making any legal decisions, okay? And then talk to your insurance provider as well. However, there are cons to having an LLC if you have an active business, and let's say you get to that point where you start making more money. The challenge with just having an LLC is that it's going to be treated as if you are a sole proprietor. And what happens is that your entire net income is going to be subject to self-employment tax, which is 15.3%. So imagine if you net $100,000. So that means $15,300 of it is going to be subject to self-employment tax. But again, if it's a rental business, you don't have to worry about self-employment tax because passive income is not subject to self-employment tax. Okay? Now unless it becomes active like a hotel. If it's not active like a hotel, then don't worry about that. Alright? Now let's talk about corporations, S-Corps and C-Corps. Let's talk about an S-Corp. Okay? When does an S-Corp make sense? An S-Corp makes sense is when you are an active business, like let's say you're wholesaling or you're flipping properties and you start making more than $50,000 net. Again, there's no rules of thumb, there's no black and white. Always talk to your tax professional. But that's just a trigger in my mind that when a client says they make over $50,000 as a sole proprietorship or as an LLC, that's a trigger in my head to start looking at their self-employment tax. Okay, is it worth us looking into a corporation? Because if you become an S-Corp, right, you are required to pay yourself a reasonable compensation. And whatever the payroll is, that's the only amount subject to payroll taxes. So let's go back to our example earlier of having a $100,000 net income, right? So if you are a sole proprietor or if you are an LLC, that entire amount is going to be subject to 15.3% self-employment tax. But if let's say we do a reasonable compensation analysis, and then now we determine that only $50,000 is required for reasonable compensation, well then you're able to basically cut your payroll taxes in half, right? So that's why S corps are popular when it comes to active businesses because it's more flexible. There's less requirements for setting up an S corp compared to a C corp. C corp has more red tape and requirements. The only thing about S corps is that in most cases, right? I never like to give blanket advice, but I say in most cases it's not a good idea to put a rental property into an S corp. We actually had a client who put a rental property into an S corp because they thought that it would save them money, and nobody advised them that this is a terrible idea. So anyway, when they came to us, I had to give them the bad news that unfortunately, when your property is in an S corp, you can still 1031, but you don't get the step-up basis. So basically, you can 1031 as much as you want. You can kick the can down the road. But once you pass away, your heirs are not going to get the step-up in basis. So you're still going to eventually pay that capital gains and that depreciation recapture. And also, if you ever try to take a property out of an S-Corp, that would count as a distribution. And that can be taxable as well. Now let's talk about C-Corps, right? C-Corps has similar cons and weaknesses to S-Corps when it comes to having properties in a corporation. So you don't get the step-up basis. And then another con to having a property in a C-Corp is that double taxation. So the C-Corp gets taxed, and then when the dividend is distributed to the shareholders, it's taxed as well on an individual basis. So that's a challenge there. The time that makes sense to have a C-Corp is if you are a high tax bracket income earner and you want to have a business or an income stream that's taxed at a flat rate, which is C-Corps are taxed at, let me double check. C-Corps are taxed at 21%. So let's put that into a real life situation. So let's say you are a high income earner, you're getting taxed at high 37%. And one tax planning opportunity is to shift some of your income into a C-Corp where it could be taxed at a lower flat rate of 21%. So that's when it makes sense to do a C-Corp. But then again, all of this is just very high level. I made it sound very simple. In reality, there's a lot of nuances to this. For example, when you're thinking about shifting to an S-Corp, one thing that needs to be balancing out is not only the same payroll taxes, but also QBI, right? Because are you losing out on QBI deduction by transitioning to an S-Corp? So that's something that your tax professional would want to check out before you pull the trigger. Because remember, once you become an S-Corp, you're stuck as an S-Corp for 5 years. So you don't want to make the mistake of picking the wrong entity type, because then you'll have to live with those consequences for a long period of time. Alright, so there you go. That's the difference between LLCs, C-Corps, and S-Corps. One that it makes sense to use each entity type in which it does not. Oh, and something I forgot to mention is that the difference between S-Corps and C-Corps is that S-Corps are not taxed on a corporate level, right? So when you're an S-Corp, you get a K1, and then your share of the income and expenses for the S-Corp goes to your 1040, and then it's taxed on your individual tax return, okay? So there you go. I hope that makes more sense to you of what's the difference between LLCs, S-Corps, and C-Corps. If you have any questions, feel free to reach out, and don't worry, your accountant handles that.
Stacked up mile by mile, it's time to sit, reflect, and add. Doing taxes ain't so bad.